Howdy, y'all. Welcome back. It's the Liberty Call for Thursday, January 6th, 2022. I hope everyone's having a fantastic Thursday out there in the interwebs. It's another pretty nice day here in Colorado. We got a smidge of snow overnight, so just a nice little dusting across my clear driveway. So when I'm done with this, I'm going to go out and scrape the snow off so I don't go slipping as I'm walking out to the mailbox. So I hope everyone's having a great day. If it's your first time watching, be sure to like, subscribe, and share with friends and family. And let's go ahead and jump into how the markets did today. All right, Dow Jones was down 0.47, S&P was down 0.10, NASDAQ was down 0.13. Both of those much better than yesterday after the Fed minutes came out and the market kind of freaked out. Small caps were up 0.4. The VIX was down 0.56. The VIX is up to 19.62. Last week, it was around 17 something. So that gives you a little perspective on where that is. I wouldn't worry about the VIX until we start creeping up towards 30. So let's keep that in mind. Across Europe, lots of red, it looks like. And same thing in the Asian markets. It looks like the Hang Seng was the only one that was up overnight. So not the best day in the market, but hey, with all the problems we're dealing with in the economy and in the markets, I'm surprised it hasn't fallen apart sooner. All right, well, I have a couple articles I want to go through. The first one has to do with the Fed's tightening and what their plans are for the next couple quarters. This seems to be the biggest amount of hand wringing based upon what I'm seeing on the television and from the articles that are coming across my stream. So let's go ahead and dive into this. This was written by Howard Schneider and Ann Safir from Reuters. All right. Alarmed by the persistence of uncomfortably high inflation, even the most dovish of U.S. central bankers now agree that they will need to tighten policy this year. The debate is no longer about whether, but how quickly. St. Louis Fed President James Bullard on Thursday said the Fed could raise interest rates as soon as March and is now in good position to take even more aggressive steps against inflation as needed. San Francisco Fed President Mary Daly, a long dovish counterpart to Bullard's hawkishness, said at a separate event that she too expects interest rate increases this year, even as she warned against overly aggressive tightening could hurt the job market. And speaking earlier this week, the Minneapolis Fed President Neil Kashkari said he now expects 2 rate hikes this year, a reversal from his long-held view that the Fed should hold off on rate hikes until 2024. Wow, that's 2 years from now. Fed policy makers are now effectively in 2 groups, those who want to tighten policy and those who want to tighten policy even faster, wrote Bill Nelson, a former Fed economist who is now chief economist at Bank Policy Institute. While most Fed policymakers remain in the first group, he said, such a distribution would result in an upside, but not downside risk to policy, barring major economic surprises, of course. It's a big shift from just a few months ago when Fed policymakers could be roughly divided into 3, those supporting faster tightening, those who embrace a slower approach, and a contingent against rate hikes for a year, if not more. But inflation is running more than twice the Fed's target of 2%. And there's waning conviction at the Fed that millions of workers sidelined by COVID-19 will quickly return to the labor force, or that supply chain constraints pushing up on prices will ease soon. So the appetite for patience has given way to an eagerness to move all that is at odds with the Fed's continued, if slowing, purchases of treasuries and mortgage-backed securities, whose purpose is to stimulate the economy. Last month, U.S. central bankers agreed to end their asset purchases in March and laid the groundwork for what most of them see as at least 3 interest rate hikes this year. Minutes of the meeting were released on Wednesday, showed that some Fed policymakers want to move even faster to tighten policy, including shrinking the Fed's $8 trillion plus balance sheet. On Thursday, Bullard laid out a case for a more aggressive path. The Fed is in a good position to take additional steps as necessary to control inflation, including allowing passive balance sheet runoff, increasing the policy rate, and adjusting the timing and pace of subsequent policy rate increases, Bullard told the CFA Society of St. Louis. An initial rate increase could be approved as early as the March meeting. Subsequent rate increases during 2022 could be pulled forward or pushed back depending on inflation developments. Speaking at an Irish central bank event, Daly, for her part, said the Fed should raise interest rates this year in the face of a very strong labor market and to rein in high inflation that acts as a repressive tax. She still said the US central bank approach ought to be measured. If we act too aggressively to offset the high inflation that stopped the supply and demand imbalances, we won't actually do very much to solve the supply chain problems, but we will absolutely bridle the economy in a way that will mean less job creation down the road, Daly said. With interest rates as low as they are, the Fed has kept its benchmark overnight interest rate pinned near zero since March of 2020. Raising them a little bit is not the same as constraining the economy, she said. Daly added that it is a very different conversation from reducing the balance sheet, as doing so would only come after the Fed has begun normalizing interest rates. So, it sounds like the Fed is becoming a little more hawkish and wanting to, raise rates, cut the balance sheet, all things I would completely agree upon. I don't know if raising rates up to even 2% is really going to do much, put much of a dent in the inflation. We've talked about before where, back in the 70s and early 80s, interest rates had to go up into the high teens to put a stop to the inflation. So, like someone said yesterday, it's like cutting grass with scissors. It's going to accomplish something, but, is it really going to solve all of our problems? I really don't know. And I mean, frankly, looking back 2 years ago, if the Fed hadn't done anything, if our government hadn't done anything, we'd have a lot less debt that we have to repay. And we probably wouldn't be in this financial position where, we're backed in or painted into a corner that, if something unfortunate were to happen in the economy, say 6 months or a year from now, what is the Fed's options going to be? I mean, negative interest rates, more quantitative easing. It just seems like all they're doing is printing money to try and fix a problem they created themselves. All right. Number two, White House says COVID stimulus talks are ongoing, but economy is strong. This was from yesterday from Reuters. The White House is in constant ongoing dialogue with U.S. lawmakers and others on COVID-19 stimulus funding, but the current economy appears strong, said the White House spokesman on Wednesday. We're in a very different place than we were a year ago or even 6 months ago, Jen Psaki told reporters at the White House, citing job creation, economic growth, but low unemployment levels and higher vaccination rates. We're in constant conversations, Psaki adding that she had no specific comment on any potential new actions. Recent economic data showed U.S. private payrolls that are increasing more than expected, strong holiday retail sales data, and easing supply chain woes. Still, the fast-spreading Omicron variant of COVID-19 has dented some sectors as some events are canceled or postponed and staffing is disrupted by positive cases. The Washington Post earlier reported that Democrat and Republican members of Congress were discussing another possible round of COVID-19 stimulus spending amid the fast-spreading Omicron variant that would target restaurants, performance venues, gyms, and minor league sports teams. Why not major league sports teams? They seem to have full stadiums. Democratic U.S. Senator Ben Cardin separately told CNN a bipartisan group is exploring whether Congress could aid restaurants and other comparable industries hit by the latest wave in cases, but that there is no formal proposal yet. Leadership is encouraging us, Cardin said, according to a CNN reporter on Twitter. The White House declined to comment to the Washington Post, as did two lawmakers cited as behind the talks. Such a measure, if passed by Congress and signed into law by U.S. President Joe Biden, would be the latest federal relief package as ongoing novel coronavirus pandemic enters its third year. Biden, a Democrat, approved a $1.9 trillion American Rescue Plan in March of 2021. Former Republican U.S. President Donald Trump approved nearly $900 billion in coronavirus-related funding in December of 2020 as part of a larger $2.3 pandemic aid and spending package. Before that, Congress had allocated $3 trillion to combat the pandemic that shut down much of the United States in March of 2020. So let's total those up. $3 trillion plus $2 trillion plus another trillion. So that's about $6 trillion in relief in the last, less than 24 months. I mean, from my point of view, it looks like the thieves in Washington are trying to loot as much money from the American people before the republic collapses and they have to go find other jobs. So we'll see. All right. This is a article from, well, I guess regarding Suze Orman. This is the only asset class with a track record of earning more than inflation. Here are three smart ways to buy it in 2022. This was written by Sigrid Forberg. All right. Let's see what Susie's ideas are and see if they're any good. With soaring inflation no longer transitory, according to the Fed, Americans are preparing for their purchasing power to take another hit in 2022. But whether inflation is coming out of hibernation or we're headed towards a bear market, Suze Orman, a personal finance expert, says you should lean on stocks for the long haul. Over the long term, stocks have produced the best gains after factoring in inflation, wrote Orman in a blog last year. Bonds and cash struggle to keep pace with inflation. Only stocks have a track record of earning more than inflation. Orman's advice is sound, but there are some areas of the stock market that perform better than others during periods of high inflation. Whether you're looking to invest thousands of dollars or just your spare change from everyday purchases, the following three sectors might give you an extra boost in 2022. Banks. In her blog post, Orman says investors should prepare for stocks to go through periods where their value dips. Duh. But that also that offers a chance to snap up more top shelf stocks at bargain bin prices when the next pullback happens, and it will happen. There's one place investors might want to look first, which is banks. Unlike the vast majority of other industries, banks actually fare well when the Fed tightens up because their asset sensitive nature. When interest rates rise, bank assets like bonds and loans tend to climb higher than their liabilities, such as deposits. Rising rates also mean that banks can earn a wider spread between what they pay out in savings account interest and what they earn from treasuries. Another great thing about buying bank shares is it's like shooting fish in a barrel. Just pick two or three of the country's largest banks, like Bank of America, Citigroup, and Wells Fargo, and you should have a positive exposure to rising interest rates that you need. We'll see. Number two is insurance. Even when people slash their budgets to help offset rising prices, we know auto and life insurance premiums will keep rolling in no matter what. Which means, although insurance may not be the most exciting industry, it's defensive business that can provide plenty of portfolio protection, especially since insurers typically earn better returns on their float when rates rise. And on top of that, insurers often pay their shareholders dividends, which means you can count on a little extra cash a few times a year. For those interested in investing in insurance, Chubb, Allstate, and MetLife are some of the big blue chip names in the industry. And lastly, precious metals. When it comes to investing in precious metals, these stock picks can be worth their weight in gold. Gold and silver have long been considered safe haven assets, meaning when all else fails, their value doesn't really tarnish. You can always buy precious metals, metal bullion or coins, but mining stocks and ETFs allow you to invest in the space at a low cost without needing to find storage. Moreover, large diversified mining companies like Rio Tinto and Freeport McMoran also dig up metals like copper, which is currently experiencing booming demand due to its role in electric vehicle production. Historically, the best time to make money from metals is when inflation is poised to keep increasing, like right now. A finer inflation hedge in 2022. To be sure, Orman's advice overlooks several attractive inflation hedges outside the stock market. For instance, fine art. Contemporary artwork has outperformed the S&P 500, commanding 174% over the past 25 years, according to Citi Global Art Market Chart, and is becoming a popular way to diversify because of its real physical asset with very little correlation to the stock market. On a scale of -1 to +1, with 0 representing no link at all, Citi found the correlation between contemporary art and the S&P 500 was just 0.12 during the past 25 years. Investing in art by the likes of Banksy or Andy Warhol used to be an option only for the ultra rich, but with new investing platform, you can invest in iconic artworks just like Jeff Bezos and Bill Gates do. So, it's definitely some good information there. Financials, like they said, typically that's where you store your money. And when the economy starts to go bad, people often will hoard their cash. So banks are going to do a little bit better. Insurance companies, like they said, most people aren't dropping their car and home rates and their life insurance. So again, those should see very little retraction in their stock prices. And of course, precious metals. I mean, you have to be a fool not to know that gold is a good investment long term. All right. 10 quick money hacks to boost your retirement savings in 2022. So since, we're in a situation where we don't know where the markets are going or what investments over the long term are going to be our best bets. Saving is probably the number one key driver to building wealth. Whether or not you're saving 10%, 20%, 30% of what you make. Even saving an extra dollar a day, and that's is what this chart in this article is about. Can have some really long-term effects on your future. So. All right. So let's see here. Even minor savings can add up to big savings over time. And what this chart shows is by saving $1 a day from age 25, by the time you reach age 75, so over 50 years, you would have an extra $110,000 saved just by saving an extra buck. Over 30, if you waited 10 years and started at 35, you would only have 60,000. So that's about a $50,000 difference just by postponing your savings, until your mid 30s. At age 45, if you started, you'd only have $30,000. And if you waited till age 55, you'd only have 14 grand. All right. So let's go ahead and blaze through this. If you want to get your new year off to a good start, try some quick and easy money moves to get yourself richer and fatten your retirement account. And don't sweat the small stuff, because over time, even the small savings can add up to big savings. Check out our chart above, which we just did. It's based on stock market history data and some simple calculations. It's what you end up with at age 75 if you saved an extra $1 a day. That's it. And these numbers are adjusted for inflation. I know someone who starts the year by putting all his leftover pennies in a cardboard sleeves and taking them to the bank, not for a few extra dollars he gets back, but as a ritual start of the year reminder of the value of your money. You don't have to go that far to turn in your pennies into retirement gold. So number one, change your cell phone plan. There's a good chance you're just burning money through your cellular plan. The average bill is about $70 per person per month, according to some estimates, as opposed to, say, this plan from Red Pocket that costs $99 for an entire year. Estimated savings, $500. There's your $1 a day already right there. Stagger your streaming services. Remember when cutting the cord on cable companies was going to save you a ton of money? Yeah, right. How many individual streaming services are you subscribed to instead? Each at $6 or $10 or $20 a month. None is costing the earth, but they add up. Meanwhile, how many of you are spent clicking around on those awful new remote controls, desperately trying to remember which one we were watching and where? Simple solution, stagger them. Subscribe to one and only one each month. Estimated savings, $300. There's $2 you've already saved per day. Switch banks for free money. A bank robber hit my neighborhood a few months ago. He got away with $300 before being chased down the street by a security guard. Meanwhile, one of the banks he tried to rob was offering $600 cash bonuses to new customers. True story. But it's not only bank robbers missing out on a freebie in plain sight. These kind of offers are everywhere if we look for them. Banks want new customers, and they are prepared to bribe us with cash to cross the road to fill out some forms. Estimated savings, $600. Go on a money fast. We all know there's so-called fast diets where you don't eat for 1-2 days a week or for even longer, something I do. Not for the faint of heart. A money fast involves a similar principle. Some people make a resolution, say, to go for one week a month without spending any money. Obviously, this relates to discretionary spending and doesn't involve skipping utilities or rent. Some nutritionalists argue that food fasting isn't really a miracle way of getting healthy. It's just a disciplined way of making yourself eat less. It's the same with a money fast. Go a week without spending a nickel, and we quickly realize how much less we could spend the rest of the time too. Estimated savings, $300 a year. Go vegetarian. Voters are getting so mad about rising meat and chicken prices that President Biden just announced an investigation, there's probably good money well spent, into alleged profiteering by big meat companies. I don't think that's the problem. Whether this leads to anything is anyone's guess. If U.S. meat giant Tyson Foods is somehow profiteering, it would come as news to Wall Street and stockholders. Tyson stock has been a turkey, but not a bull over the past 5 years, underperforming the S&P 500 stock by about half. One reason meat and chicken is so expensive is because they use up so much energy to produce, which is why they are so bad for the environment. I don't think so. Cows poop and fertilize the grass. This guy slashed his food costs almost a decade ago by switching to vegetarianism and never looked back. He saved, $200. I'll eat a cow. Sign up for a new credit card. Banks are giving away free money just for checking new checking savings accounts. They're also eager for new credit card customers. Offers that come through the mail for $200 or $300 sign up bonuses. If you sign up for the latest credit card and they don't come through the mail, you can find them online. Watch out for annual fees and make sure they don't end up carrying over a balance from month to month, or you'll end up paying the bank more than they pay you, which, of course, is what they want. But do it right, and it's free money. Estimated savings $300 a year. I will agree. Interest rate shopping on credit cards and balance transfers, is often a way to consolidate your debts and also, pay them off in a shorter manner with a lot less interest. Stop lending your money free to the richest guy in the world. If you're like 120 million other taxpayers and about 3 out of every 4, you're paying too much tax every pay cycle. Over the course of a year, you're paying about 2,900 too much, and you get the money back when you file your taxes in the form of a refund. Congratulations, you just lent the money to Uncle Sam for free. Meanwhile, of course, you're probably borrowing money from your mortgage provider, credit card company, and other places, maybe paying as much as 30% interest. And if you're like most taxpayers, you're doing this every year. Simple solution: file a new W-4 with your employer and lower the amount of taxes withheld or pay up front from each paycheck. Result, you get to keep your money when you earn it. Then you can pay off the debt or your credit cards. Or if your credit cards are paid off, it can go into a 401k or IRA, where instead of earning you 0%, you can earn on average inflation plus 6%. So that's an average savings of $200 a year. Open up another IRA. Don't contribute to your tax advantaged IRA as well as the 401k at work. If you have a spouse who is not in paid employment, are you contributing to a spousal IRA for them? And if you have not any kind of side gig or hustle, are you contributing to a SEP IRA out of those earnings as well? If not, you're probably leaving money on the table. You can contribute up to $6,000 to your own and spousal IRA, and an extra $1,000 if you're over 50. And a SEP out IRA limits are up to 25% of your self-employment income, or up to $61,000 a year. Estimated savings, thousands. Change your insurance. Those commercials telling you can save hundreds of dollars if you switch from company A to company B. I think they have a little lizard who does that. And those other companies saying the exact opposite. They're all true. You can pretty much always get a better deal if you shop around, whether it's on a household or a car or other types of insurance. Just as the Mustard King used to say, he made his money the simple way, made his money. Oh, God damn. Just as the Mustard King used to say, he made his money from what people left on the plate. Insurance companies make their money from people who don't switch. It's just a hassle after all. And it is a hassle, but it also saves money. And money saved, unlike money earned, is free from the federal, state, and city taxes. Estimated savings, $300. Stop paying someone else to give you caffeine in the morning. No money tips are complete without mentioning David Bach's so-called latte factor. But the daily giant money drain continues. Americans give Big Latte about $20 billion last year. Actually, that was the number from just one company. And this, even though it is getting easier and easier to make your own great cup of coffee or tea at home, and even as lattes cost a lot of more, estimated savings is $300. So total savings, $3,000. Okay, so it's notional, and some can save more, but others way less. But every dollar counts, and if you save $3,000 a year for 30 years and invest it into stocks, and on average, you'll end up with an extra quarter or $240,000. Not bad for a little work. So, I suggest doing this probably at least once a year, maybe twice. Go through your budget, see where you're wasting money. If it's on subscriptions or whatever it might be, or maybe like the last thing, you're going to Starbucks every day and spending $5 to $10 on coffee and Danish. Maybe make your own Danish and brew your own coffee, and you can do it for probably less than $1 a day. All right. And the last article is 3 signs you're ready to retire. It helps to be mentally and emotionally prepared, just not financially. And let's see here. This article comes from NerdWallet. Many people don't have much of a choice about when they retire. Illness, job loss, and caretaking responsibilities put them out of the labor force, ready or not. But some people have the opposite problem. They do have a choice, and they can't quite bring themselves to quit working. Some love what they do and never want to retire. I'm in that category. Others are paralyzed by fear of the unknown, financial planners say. They may worry about living without a paycheck, spending down the money they work so hard to save, or figure out how to structure their days in the absence of a job. A lot of people are saying, a lot of people I see are financially ready before they're emotionally ready, said Kathy Gehrig, a certified financial planner in Rochester Hills, Michigan. If you're struggling, here are the signs you may be ready to retire. You faced your fears. Retirement is often depicted as an endless, stress free vacation. In reality, retirement requires some potentially stressful paradigm shifts or fundamental changes in people's approach to life, says CFP Barbara O'Neill. Flipping a Switch, author of Flipping a Switch, Your Guide to Happiness and Financial Security in Later Life. Instead of earning a paycheck, for example, retirees have to create one from their savings and other resources. If something goes wrong, the furnace dies, or their investments don't do well, they can't just earn more money to make up any shortfall. Those who've been diligent savers often struggle with the idea of spending their money in retirement. It's really emotional for people, says CFP Janice Kakawaski of Willoughby, Ohio. They're so used to seeing their account balances increase over the years, and they find it really difficult to pull money out of their accounts. Other fears, such as being afraid of becoming irrelevant or simply being bored, can cause people to postpone retirement, according to some financial planners. Gehrig says some of her most successful clients, including business owners and top executives, have prioritized work to the point where they can't imagine life without it. Honestly, the biggest fear I see is what I'm going to do with myself if I don't go to work all day. Once you know what frightens you about retirement, you can begin to address those fears, financial planners say. Your financial plan has to be stress tested. If your fears are financial, you can hire a fee-only financial planner to review your retirement plan. Choose a financial planner as a fiduciary. I know someone, which means they're committed to putting your best interests first. Getting an expert review is a good idea in any case. The planner can help you maximize Social Security benefits, navigate Medicare and other health insurance options, decide the best way to take your pension, and plan for a long-term care and figure out a sustainable way to withdrawal rate from your savings. This will be your only retirement. It's paramount you get it right. Using sophisticated planning software, the advisor can stress test your plan to see how it works in the event of a major market downturn, a surge in inflation, higher taxes, or premature death of you or your spouse. Let's see. CFP Michelle Gessner of Houston runs her clients through plans through various combinations of events. Then she runs a maximum spend test to see how much the money they can spend before the plan fails and they run short of money. It's something I do with those who are retired and usually have a lot of assets. I usually run what they're doing, worst case scenario, and then, how much can they spend every year and not run out of money before like age 95 or 100. So, something that I've been doing for a while, and it can be difficult for folks, to see their account balances start to go down as they're in retirement, simply because, you're exhausting your resources. All right. You know what you're retiring from, just not from. Many retirees struggle, at least at first, to find a sense of purpose for a structure of their days. Having a plan to know how you'll spend your time can help, says CFP Ian Weinberg of Woodbury, New York. This plan might include a bucket list of travel and experiences you can start checking off. Or you could just create a pie chart or a schedule on how you want to divide your time among various pursuits: hobbies, volunteering, physical fitness, family time, travel, and so on. Retirement can be unexpectedly lonely, especially if you're single or your partner is still working. If your primary social interactions were with coworkers, you might need to find some new friends, says CFP Hattie Black of Birmingham, Alabama. Black recommends checking out volunteer groups, clubs, and classes. You may need some time to prepare yourself mentally and emotionally for retirement. Just don't let the preparation continue indefinitely, since the future is never guaranteed, Gehrig points out. Jump in and enjoy the ride. And I would agree. You have to definitely plan out what you're going to do with the rest, the last, hopefully third of your life. Say you retire in your 60s or 70s and you got another 20, 30 years left. I definitely recommend getting involved in community organizations, whether or not it's like my grandparents. They were very involved in the Elks in Kemah, near where they lived. My grandfather was also on the city council in Kemah. So, keeping busy is very important. Just because you're not drawing a paycheck doesn't mean you can't go, maybe mentor people, young people who maybe want some job skills or life skills. You could set up some meetups. And, if you have some, whether or not you're an engineer or, whatever career you had in the past, you could always take, the best practices you learned and then, pass that on to the next generation. So, all right. Well, I managed to ramble for 30 minutes today. I had a lot of good stuff. I hope you found it valuable. And I will definitely be back tomorrow with, tomorrow's Friday. We'll have the weekly wrap up. We'll go over employment numbers and all the good stuff from there. So, hope everyone has a fantastic evening, and I'll see you then. Bye bye.